Welcome back to the deep dive. So, we usually obsess over price charts, right? But today, we're kind of ignoring the scoreboard to look at the rulebook itself.
Exactly. We've got a whole stack of material here on corporate structure, regulations.
And the big question we're asking is when you buy a share, what do you actually own?
It's a great question, and it's deceptively simple. People think, I own a piece of the company. And well, yes, technically, but these sources paint a picture of a really strict hierarchy,
A spot in line.
a very specific spot in a liquidation line. You're not just buying a ticker.
Okay, so let's start with that pecking order idea. It seems like there's this huge wall between debt and equity.
It's the first and most important split. It's really the difference between being a lender and an owner. Bondholders, they're lenders.
They just want their interest payments.
They don't really care if the company is the next big thing. They want their money back. But because they don't get that massive upside, they get security.
The lifeboats.
They get the lifeboats. If the company goes Titanic, they're first off.
And common stockholders.
Oh, they go down with the ship. It's called a residual claim. You get what is left, if anything, after everyone else gets paid. The government, employees, bondholders, everyone.
So why on earth would anyone sign up for that? To be last in line?
Unlimited upside. A bond's return is capped. A stock's isn't. Plus, and this is key, you get to vote. You get the keys to the car.
Right, but the sources made it clear that not all voting is created equal. This statutory versus cumulative thing.
Yeah, statutory is what you'd probably expect. One share, one vote per board seat. If you have 51% of the shares, you win 100% of the seats.
It's a winner-take-all system.
Totally. But cumulative voting is, it's more strategic. It lets you take all your votes and pile them onto one single candidate.
So you could ignore a few seats to make sure you win just one.
Exactly. It's a loophole, really, designed to give a minority shareholder a fighting chance to get a voice on the board.
Okay, so sitting somewhere between the safety of bonds and the risk of common stock is this other thing, preferred stock.
The chameleon. That's a good way to think of it. It's legally equity, but it acts a lot like a bond. You get a fixed dividend, usually you don't get to vote.
And you stand in front of the common stockholders in that payout line.
You do. And the cumulative preferred feature is a big deal here.
That sounded like you're running a tab with the company.
That's basically it. If the company is tight on cash and skips your dividend, they can't just forget about it. It goes into what's called arrears.
And they have to pay you back everything they owe before the common shareholders see a dime.
Not a single penny. It's a huge protection. But the trade-off is you're usually locked into that fixed return.
Unless it's convertible preferred.
That's where the hybrid thing really shines. You take a lower dividend now for the option to swap your preferred shares for common stock later.
So if the company explodes in value, you can jump off the slow and steady train and get on the rocket ship.
You stop acting like a lender and you start acting like an owner.
Okay, let's talk about the sweeteners, the derivatives, rights and warrants. They look almost identical at first glance.
They do. They both let you buy stock at a set price. But their whole psychology, their purpose, is opposite.
Preemptive rights are for existing shareholders. Right, it's like an insider deal.
A very short-term VIP pass. It's to prevent dilution. The company is issuing new shares, and it lets you buy them at a discount to the current market price, so your ownership stake doesn't get smaller.
So a right is almost like instant on-paper profit.
It can be, yeah. A warrant, though, is a lottery ticket attached to a bond.
A lottery ticket with a long shelf life.
A very long one, sometimes years. A company will attach them to bonds to make a lower interest rate look more attractive. The catch is the exercise price is set higher than the stock's current value.
So a warrant has no value when it's issued. It's just a bet that the stock will soar someday.
One is about protection. The other is pure speculation.
All right, we can't talk about issuing stock without the guardrails. Rule 144 came up a lot.
The lockup rule. I mean, this is critical. It stops insiders who have unregistered stock from just dumping it all on the market after an IPO.
There's a holding period.
Usually 6 months for a reporting company. And even after that, if you're an insider, what they call a control person, there are strict volume limits.
You can't just sell everything at once.
No, you can't. It stops the CEO from crashing their own stock price on a whim.
Speaking of price, what about when the company itself is buying? Rule 10b-18. The buyback rule.
This is the safe harbor. A company buying its own stock could easily look like manipulation. So this rule sets guardrails to prevent that.
Like what?
You can only use one broker-dealer per day. You can't buy at the market open, and you can't buy in the last 10 or 30 minutes of trading. And you can't buy more than 25% of the stock's average daily volume.
So it forces them to be a passive buyer, not an aggressive one.
Exactly. It keeps the playing field level.
So zooming out here, we've got liquidation lines, voting tricks, regulatory handcuffs. Why does this matter to the average person listening?
Because your risk isn't just about what a price chart is doing. A defensive utility stock is built differently than a cyclical car company. Knowing where you stand in that pecking order, if you own the bond, the preferred, the warrant, that tells you how much pain or gain you're signed up for when the market inevitably turns.
And here's a final thought for you. When a company issues a warrant with an exercise price 50% higher than today's stock price, is that a sign of incredible confidence in their own future? Or is it just a clever way to sell you a mediocre bond? Thanks for listening to this deep dive.